As the summer of 2023 approaches, the European Central Bank finds itself at a crossroads. For the past 4 months, inflation in the Eurozone has been gradually easing, providing a glimmer of hope for consumers and businesses alike. However, recent forecasts suggest that this respite may be short-lived, with price pressures expected to pick up once again in May. This development has left analysts and policymakers alike grappling with the implications for the ECB's much-anticipated interest rate cuts. The ECB, led by President Christine Lagarde, has been signaling its intention to lower borrowing costs at its upcoming meeting on June 6. This move, widely expected by markets, is seen as a necessary step to support the fragile economic recovery in the wake of the COVID-19 pandemic and the subsequent energy crisis. However, the prospect of rising inflation has thrown a wrench into these plans, forcing the central bank to re-evaluate its approach. According to a recent forecast by Barclays, consumer prices in the Eurozone are expected to be 2.5% higher in May compared to a year ago, a slight uptick from the 2.4% recorded in April. While this may seem like a minor change, it has significant implications for the ECB's decision-making process. As Mark Kazbabik, an economist at Barclays, explains, unfavorable base effects in energy will be the primary tailwind for headline inflation, pushing it to accelerate slightly. Additionally, the launch of subsidized German train tickets last year is expected to contribute to a rise in services inflation. The timing of this inflation data is particularly crucial, as it comes just a week before the ECB's pivotal meeting. While most analysts still believe that the central bank will proceed with a rate cut, the magnitude and trajectory of future cuts have been called into question. ECB policymakers have been divided on the issue, with some warning that higher inflation readings could make the central bank less likely to follow up with another cut in July. Frederic Ducrozet, an economist at Pictet Wealth Management, echoes this sentiment, stating, "The ECB will probably deliver a first rate cut at its June 6 meeting but then pause in July, on the back of sticky wages but also services inflation, which we expect to remain elevated on a sequential basis in May, not least due to base effects in Germany." This uncertainty surrounding the ECB's future actions has left businesses and investors in a state of limbo. For companies, the prospect of higher borrowing costs could dampen investment and hiring plans, while consumers may feel the pinch of higher prices and reduced purchasing power. The ECB's ability to navigate this delicate balance between supporting growth and keeping inflation in check will be critical in determining the Eurozone's economic trajectory in the coming months. The situation in Europe is not occurring in isolation, however. Across the globe, central banks are grappling with similar challenges as they attempt to unwind the unprecedented monetary stimulus unleashed during the pandemic. In the United States, the Federal Reserve has already begun raising interest rates, with further hikes expected in the coming months. Meanwhile, in China, policymakers are focusing on supporting the country's manufacturing sector, which has been a key driver of economic growth. Chinese factory data, set to be released on Friday, will provide further insights into the health of the world's second-largest economy. President Xi Jinping's government has emphasized the need for high-quality production, particularly in areas such as electric vehicles and artificial intelligence. The Official Purchasing Managers' Index, a gauge of manufacturing activity, is expected to have edged higher to 50.5 in May, indicating a modest expansion compared to the previous month. While recent economic data from China has been mixed, with strong manufacturing output contrasting with weak retail sales and investment, the country's recovery remains crucial for the global economy. As Carlos Casanova, senior economist for Asia at UBP, notes, the nature of China's recovery remains lopsided. This unevenness has implications not only for China itself, but also for its trading partners, including the United States and Europe. In the United States, the focus will be on the Federal Reserve's preferred measure of inflation, the Personal Consumption Expenditures (PCE) index, which is set to be released on Friday. Economists expect the PCE data to show that prices in April rose at the same pace as in March, despite a slowdown evident in the Consumer Price Index last month. While the PCE data may not reflect the same improvement as the CPI, analysts argue that unchanged PCE data is unlikely to alter the cautiously optimistic tone that has infused markets since the CPI release. As Ian Lingen, head of U.S. interest rate strategy at BMO Capital Markets, explains, despite core PCE's status as the Fed's preferred measure of inflation, we're less convinced it will change the market's prevailing perception of the pace of consumer price inflation as the second quarter got underway. In short, investors are cautiously optimistic that the Fed's characterization of the first quarter as a bump in the road towards cooling inflation is, in fact, an accurate read. This optimism, however, is tempered by the realization that the path to sustainable growth and price stability remains fraught with challenges. The ECB's upcoming decisions, along with the economic data from China and the United States, will play a crucial role in shaping the global economic landscape in the coming months. For ordinary viewers who have long been concerned about financial developments, as well as those professionally engaged in finance-related work, these developments serve as a reminder of the complex and interconnected nature of the global economy. The decisions made by central banks and policymakers in the coming weeks and months will have far-reaching implications, not only for businesses and investors, but also for the everyday lives of millions of people around the world. As we navigate this uncertain terrain, it is essential to remain informed and engaged, to understand the forces shaping our economic future, and to advocate for policies that promote inclusive and sustainable growth. Only by working together, across borders and across sectors, can we hope to build a more resilient and prosperous future for all.